There's a couple of things I just wanted to end up talking about kind of on the crop outlook and some of the seasonal trends that we've seen. And we've mentioned this a few different times. One thing that I always like to end up looking at is this vegetative drought responded index. There's plenty of other things that we can end up looking at in terms of monitoring drought and crop progress. And I will talk a little bit about the crop progress report, not because I think it has a ton of information, but it does give you a really good sense as to where we are in terms of a national picture in terms of yield potential right now. And so when we're thinking about some of the data that we look at and what some of our expectations are, I think it's important to end up considering multiple sources. I do want to talk a little bit about supply and demand on corn and soybeans, and then step into the price outlook, and then talk just really quickly about pricing strategies, where you can get some pricing data, and then close out with just kind of looking at storage. And so, as mentioned, this is a crop progress report nationally for corn, and you can see that top line there with 2025 data. You can see the percentage of crop that's in good and excellent condition. We are near all-time highs for this week in the year in terms of nationally. And that's got a lot of people speculating that this is going to be a very big crop nationally when we look at this. And you can kind of see that through the condition down here as well, where you see poor and very poor. It almost doesn't show up on the graph. You have a substantial amount that's in the excellent, good, and fair condition. We are still kind of, we still got a fair amount of the growing season to end up going, but we're positioned very well to end up having a very good corn crop this year. When we look at Tennessee, as Andrew mentioned, there's some drought that's crept in some areas, so we're maybe not as high nationally. We still have some really good corn crops out there. We'll see how the crop ends up finishing. But again, we're not at that same maybe near record that's out there in terms of the national crop. When we look at soybeans, again, the national picture is very good in terms of where we are for this week in the production year. And again, that's going to end up potentially building the size of supplies as we enter into this marketing year. Same thing for Tennessee, because we got off to that late start. I think some of our crops in a little bit rougher shape than typically. And so again, I think that's kind of showing up in some of the numbers. We are a little bit behind down here. If you look at where we are in terms of 2024, and typically we have been kind of a little bit behind when we look at planting for some of our crops. I did mention just supply and demand. There's a couple of key numbers that I'm really focusing in on. The first one is the U.S. average national yield. There's going to be an update provided August 12th. Most people are speculating that 181 bushel per acre average yield is going to be increased substantially, maybe above 185 bushels per acre. That'd be an all-time record. It would also be above trend line yield when we look at kind of adjustments year over year. What that would do is that would substantially change where we are from a stocks and supplies standpoint. If you think about 87 million acres and adding 5 bushels per acre, maybe, that's a lot of corn that is going to be there. And what that will necessitate is access to foreign markets. And so when we look at that export number, if we build this big supply due to very good production conditions nationally, we're going to need exports to alleviate some of that supply. And so access to markets is going to be really important as we go through this crop marketing year throughout the early 2026 and the end of 2025. The other one that I'm interested to see how it finishes out is a South American crop. They're down in Brazil. They're harvesting their second corn crop. There's some pretty good indications that they'll be a little bit higher up there. So again, when we think in terms of formulating price expectations, prices are down substantially. We'll talk a little bit about that. I think we're probably getting pretty close to a floor, but this yield number is really going to dictate whether we have another step down or whether we start to end up building a base which we can improve on throughout the winter. Again, the data right now that we're looking at does not support substantial price increases, but I think there is some justification that we may be approaching a low. Similar thing with soybeans. I think there could be a yield revision. I don't think it's going to be as big as the corn number in terms of increasing when we look at the August 12th number. The two numbers that I'm really looking at in terms of soybeans that could really help at least push prices off the bottom here is the crushing number. That's been very robust. Exports has been challenging because we're running into really stiff competition out of South America. That's just one of those ones that's a challenging one because of the size of their crop. And obviously, with the amount of foreign stocks out there, it does not look like there's a substantial price improvement for soybeans in the cards as we move through the end of 2025. Maybe if we see some disruption in the primary soybean growing season in South America, which will start in our fall all the way through January, there could be the potential to help prices during that interval, but that remains highly uncertain because they won't start to plant that crop until closer to September. When we look at profitability, again, everybody's operation is going to be a little bit different, but what I like to try to end up highlighting is just some of the trends in profitability. And so what we're using right now is just a standard trend line in Tennessee. We'll get more information about state average trend line yield. I pulled harvest prices. None of that is going to get producers excited. Depending on what area of the state you're in, prices are going to vary just by local basis, but most of the prices that we're seeing are well below what cost of production is. And so when we look at that returns over specified costs, we're looking at some negative profit numbers on average for the state. There will be producers that are profitable, that have lower cost structures, or higher yields that can end up offsetting some of that. But on average, we're looking at the potential for a challenging production or profitability year when we look at 25 and 20 into 2026. And if you look at these break-even costs, there's a substantial amount of difference between where we are in terms of average break-even to cover true economic costs versus where we are in terms of current prices. Now, again, if we get increased yields, we can end up seeing some of that offset. One of the big ones that I've focused on telling a lot of producers about is focus on making sure that you're covering those cash costs. And what I mean by that is just the money that's going out the door on a day-to-day basis. Economic costs include things like capital recovery, where in the short term you can farm just covering your cash costs, economic costs. You can maybe eat into some of that in the short term, but long term we need to be able to replace things like equipment. And so again, we do want to end up being cognizant of those two distinct cost categories. When we look at December corn, I wish there was a better picture, but there's no question that we've been in a free fall in this market, dropping from early in the season where we were up at that 480 mark. Now in the futures market, we're down pushing below $4. You can look at the spreads from September all the way through July. But the nearby at 380, that's a real challenging number when we look at a profitability standpoint. December's a little bit higher. What we're likely to end up seeing is some continued weakness in the December, particularly if we get some of those high yields. So again, I would suspect that we may see that December fall down into that 385 range as the September contract comes off the board at the end of or in the middle of September. When we look at soybean prices have actually been weaker for a longer period of time. If we think back to last year, we've seen our big decline and we've kind of moved sideways in that tight trading range. What we've seen is we're not at the contract low here, but we're below that $10 mark, which is concerning when we look at the potential to end up getting profit out of this crop, even if we do have some big yields. You can see the carry in the market. I'm going to talk a little bit about storage at the end of this presentation, just to end up discussing what we need to potentially looking at. Cotton, again, cotton markets have been very weak for pretty much most of the production year. There's nothing on the horizon that would indicate that we're going to end up seeing a return to over 70 cents for cotton in the short term. One thing that does give me some, I guess, reason to believe that we are approaching a bottom in the corn market is when we look at the inflation adjusted prices for nearby futures. And what this shows all the way back to 1980, but we're putting it in today's dollars in the black line there, which is an average of 540 on the futures. And what you will see is when we enter these low price environments, adjusting for inflation, we typically bottom out someplace on the nearby futures, somewhere between that 360 and 375 range. This year, we might forge below that just because of the size of the crop. But the takeaway here is that we're closer to the bottom of this market. Again, you have to be cautious because we're not going back up to $5, But at the same time, if we set a bottom, can we end up starting progressing so that we can get, above $4 on the futures market? Slight increases would be beneficial to profitability. When we look at futures price ranges, I've got them up here at 360 to 450. Obviously, the top of that market has kind of been shaved down from earlier season adjustments just based on the size of the crop. Soybeans 935 to 1060. Again, a lot of that is going to be dictated if we have a chance to get up above that 1050 mark. It'll likely be due to some changes in the South American crop, primarily how many acres they're going to end up planting. I think that's something that'll be very interesting to end up seeing, because obviously they're facing the same global price structure as what our producers are. So do they pull back on some of their acreage when they see what the current price offerings are? And then again, cotton and wheat have also been very weak when we look at prices. So we're talking with producers about pricing alternatives. I just want to kind of just a quick review of kind of some alternatives that are out there. Cash contracts are probably the most popular method to end up pricing corn and soybeans in Tennessee. Your cash forward contract locks in the futures plus the basis, so you're establishing a fixed cash price. For those that want to fix a futures price, an HTA is the tool to end up doing that. It's not a futures position; it's an actual contract, so there's no margin requirements on that. HTAs right now, you're probably looking at deferred months, so months further into the future, not nearby, maybe capture some of that carry in the contract. Basis contract is just locking in that local basis, and that's one that I think we need to have producers really in tune with what's going on with local basis. If there are opportunities that are beneficial to lock that in, and then you can always look at futures and options positions. One that I always look at, and this is a USDA price report. So if you get producers that are asking for prices, depending on which region of the state you're in, this is great for West Tennessee. If you're in southern middle Tennessee, Woodall's and Tyson have some pretty good data in terms of looking at what basis offerings are and what cash prices are. So when you look at this by region, the two things that I always want to highlight is where the price is, where it is compared to a year ago, and then when that delivery interval is, because you can end up signing cash contracts for different delivery intervals. And so again, you can end up looking at that current period, or you can look at times in the future. It's just a quick reference. They update this on a daily basis. It's an easy way to go out there and just pull some data. But again, you have to be very careful with what region you're looking at, because what we do in West Tennessee, Middle Tennessee, and East Tennessee can be very different in terms of cash offerings. When we look at call options, I think that's one that we can use specifically if you don't have access to a lot of storage. You have to be cautious with this. What you're doing is you're potentially purchasing a call option to participate in a price rally if you can't hold a commodity in storage. Again, the way to end up reading this is you have all these different strike prices. This is what the premium cost is. If you're purchasing a call option, where you get a financial benefit is if the futures market goes above that strike price. So again, this is just a tool that's out there. If you have producers that are interested in this, we do have some resources out there that can better describe how to use this effective. But this can be a real effective marketing alternative when a futures market is in the process of bottoming. One of the ones that I always like to quote is Richard Brock always says, you don't buy something because you think it's going to go up. You buy something because you think it's stopped going down. And the rationale behind that is it's a difference in what the risk profile is, right? If you think it's stopped going down, then you probably have less risk to the downside and more to the upside. Call options can be a way to end up taking advantage of that. Storage, I know we always get a lot of questions on return to storage. This is the historic, so 10-year average returns to storage for corn and soybeans. The way to end up reading this is if you hit that harvest low, if you are able to store soybeans, on average to March, you will get $1.43 per bushel higher. That's on the cash price. That incorporates basis and futures. On corn, if you store from the harvest low until March, you get on average 77 cents per bushel. Again, one thing that is challenging is every year is different. That doesn't mean that every year you're going to get that return to storage. What it says is on average, you're going to end up getting that if you look at a 10-year interval historically. So what we still need to end up doing is to end up looking at evaluating what the market is offering before we put commodities into storage. And so this is just a simple spreadsheet that we've developed where you can end up looking at what the current futures prices are for the different contract months, the months, calculate what that futures price spread. We can incorporate basis. I did not in this example, but we can end up doing that to end up seeing if there's a higher basis in deferred months. That's obviously going to affect our cash price spread. And then calculating interest, right? Because we are still at a high interest rate environment. I've got 9% in here. And so you can see just in interest cost only for corn and soybeans, it's 3 cents and 7.5 cents per month to end up just paying the interest cost on that value for 9%. That doesn't include an additional 3 to 10 cents per month that may be incorporated in terms of handling charges, capital recovery, those other types of things. But what this allows us to end up looking at is which one makes maybe more sense to end up storing. Are you looking at a better return on corn or soybeans for these different months and intervals of storage? And so again, if you see negative numbers on here, when you end up running the calculation, that's giving you a strong indication that you probably don't want to store that just because you're not even covering your interest costs. So again, even if you look and there's an actual nominal or an actual spread or difference between the nearby price and the deferred price, you still have to figure out if that carrying cost is going to be able to be recovered when we're looking at that. So evaluating if the crop should be stored and then also which one of the crops should be stored, I think is just an imperative thing when we look at these very low profitability years, because it does give us some ability to maybe generate a little bit more money on this. And so when we look at kind of another question I get quite often is post-harvest marketing tools. And so again, it really matters if you have available storage or you don't have available storage as to whether or what type of tools you would end up potentially using. So if you do have storage available, what you can look at are all those deferred contract months. So you can throw some corn or soybeans in storage and look at pricing out into March. That's something where, again, you can capture some of the carry in the market and the potential for seasonal basis improvements. It makes it so that you don't have to end up having a futures position. It is a cash contract, and you don't have as much production risk, right? Because it's in the bin. You do have to maintain quality and make sure that you're monitoring it. But at the same time, I think that's a useful tool. Another one that I think is worth considering this year is USDA marketing loans. And the reason why I bring that up is what it allows producers to end up doing is going to their FSA office, getting a marketing loan at potentially a lower interest rate than what the market is offering to get some liquidity to end up paying expenses. And again, you still have to repay that loan, but if you have, say, a traditional operating loan and it's at 9%, and you can get a marketing loan for 6 to 9 months at, say, 5.5%, you can end up or you can save that 3% interest. That's a pretty good sized number, particularly in a tight margin environment. So again, that's, I think, something that's worthy of talking to our producers about and encouraging them to speak with FSA about some of the marketing loan programs. I know historically it's more readily utilized in cotton, but I think under these conditions, saving a few cents in terms of just interest expense, I think is worth considering because we are in such a tight environment. And then again, you can always use futures and options. When you don't have storage available, you're looking at basically re-ownership strategies in the futures market. I mentioned purchasing a call. You can also buy futures. That's something that you can do. It is not without risk and it is a speculative position, but it can be something where if you feel strongly that the market's going to end up improving as we move out of the harvest interval, you have to look at the contract and what the spreads are doing, but there is some potential to end up having a re-ownership position in the market. So just kind of in terms of take home on the crop side, I hate to be the bearer of bad news, but we're likely to have a very, very challenging price environment as we continue to move through this year. A lot of when we bottom out in prices and how low we get is going to be dictated in the next couple of months here when we get these yield estimates. If we see national average corn yields above that 185 bushels per acre, we're going to see a little bit more price softness. We could get down into that kind of 360 range on the future side. If it surprises and they take some of the top off that yield estimate, we could end up seeing a bit of a recovery. But at the same time, the expectations have to be tapered. It's gonna take a lot for us to to get up even close to that 450 range. So again, I think that's some real challenging things. One other thing that I think is worrisome is because we've been in a lower price environment. I've spoken with a lot of brokers across the state, and I worry that we don't have much of the crop priced already. So there are some people that have priced more aggressively at the start of the year, and that's when we had our best pricing opportunities. But I worry that on average we're going to have less production priced at this point than even in a typical year, which is not a positive thing based on the current market. We need to end up really considering that storage capacity and if that crop should be stored and for how long. We have to be reactive to market signals. I'm still a massive proponent of having on-farm storage capacity. I think it's something that can really be a real benefit to producers in Tennessee, but we really need on an annual basis to determine if this crop should be stored. If we do start to see price rallies, big proponent of incremental pricing into a rally. And what I mean by that is if the market goes up, say 15 cents, maybe you price an additional 10% of the production that you have. I think holding out for a dollar rally, you're just going to be sitting on that corn for forever. Pricing a little bit into these rallies just in case there's a correction and we come back down, I think is a pretty reasonable strategy. You're not maybe going to hit a home run, but if you can end up, mitigating some of that risk and at least not selling at the absolute bottom, I think that might be a worthwhile strategy. When we talk about basis offerings, I think it's been well documented the last few years, some of the challenges we have with the Mississippi River. When we get low water levels, it adversely affects our basis. So just be cognizant of that. It's a little bit too early in terms of looking at forecasts to see where we're going to end up being. But if you do see a reasonable basis offering right now, it may not be a bad thing to end up locking that in, particularly in West Tennessee. If you're 20 under the board and you don't have storage, you may want to end up actually looking at that if you have to end up moving that commodity, because in the past when we've had those low water levels, we've seen it get almost $1 under the board. So again, it's just a risk strategy that has to be considered based on uncertainty. When we look at the winter, this is going to be a real challenging winter for a lot of our row crop people. Profitability is just not there right now. There are going to be some government programs that will assist a little bit, but it's going to be very challenging for a large chunk of our row crop producers, and that's going to potentially bleed into the 2026 crop when they look to end up providing financing. The last thing I'll close with is just there is a new farm bill that is potentially gonna be finalized before the end of this year. I look at that as more probably as a long-term adjustment to the safety net, so I don't necessarily think it's going to be of tremendous benefit for this year. And so we'll wait and see. But again, I think this is going to be real challenging. I wish there was better news on the crop side, but right now it's a pretty bleak outlook.